Good morning, everybody. It's Thursday, November 21st, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, December corn down a penny at 4.29 1/4. January soybeans were up a quarter at 9.90 3/4, and December Chicago wheat was up 3.5 at 5.56. This morning, we had a couple of export sales announcements, 198,000 metric tons of soybeans to China for 24, 135,000 metric tons of soybeans to unknown, also for 24, and 133,000 metric tons of soybean meal to the Philippines for 24. Looking at weekly export sales out this morning, solid week for corn, just under 1.5 million. Soybeans at the top end of the estimates, above the top end of the estimates at 1,860,600. Wheat pretty much in line, 549,600. Meal 274,900, which was at the lower end of the range, and soybean oil at the top end of the range at 21,900. Good morning, fellas. We were talking before the show. There's been a lot of questions, chatter, people, reaching out to get our opinion just on some of these new crop economics between corn and beans. And I know we've talked a lot on the show, at different times about what we've seen, from the pricing aspect of those two markets. But, now as we get, deeper into the winter, harvest is in our rear view mirror. Guys are starting to look at, what are the true economics. So with that, Dustin, maybe a few thoughts to start off, and then we'll throw it around the room.
Yeah, thanks, Dan. So, I think these numbers came out earlier in the month of November, like November 6th or 7th, and there's been some discussion online about them. This is the Purdue 2025 crop budget numbers. We have talked about the farm doc numbers as well. We continue to kind of hear on Twitter and just, market talk how the economics of corn make a lot of sense. And that's not what we've seen anecdotally, corn on corn economics rather than bean on corn. And I think this just is another example of that. If you look at Purdue's, average productivity soil, they have rotation beans coming in around $249 an acre above the variable costs, using, their yield and price estimates, 985 harvest price with a 60 yield versus a 410 harvest price and a 183 yield. Now, of course, everyone's going to be different. The yield numbers for average productivity soil might look a lot different in Illinois, for example. And certainly as you get into the higher production ground, I think that gap between corn on corn and beans on corn starts to narrow. However, just in our experience, we look at these numbers and we look at, what our base has done over the last, 6, 7, 8 years, how they've really switched to more rotation. In our view, I think that the economics say there might be a more even split of beans and corn acres than, going back to let's say 2023 type corn numbers where we are very heavy corn acres. And the reason for that is not just because of, the ratio, it's also because flat price, when we're projecting losses, if we go down to, this is just the Purdue page, we go down to page 3, you start looking at the projected losses on average productivity soil that they're estimating at least. Again, it's going to differ for everybody. We are still looking in the hundreds of dollars an acre of loss projection for your rent ground in corn on corn country. And that, to me, I think that there's something very unsustainable about that when global corn stocks to use ratio is down to 10.5% when you take China out of the equation. China is not going to be an exporter of corn. How much do they import is a question, but current WASDE report literally publishes world minus China numbers for a reason, is that we can't really take their stocks at face value following their 2018 revisions. So are we getting into a situation where the market may be disincentivizing enough corn acres and then all of a sudden demand panics going into 2025 harvest, right? That's a script that I could definitely get behind and not be surprised to see. So just keep that in mind. Probably best to do this yourself and still figure out what your own economics call for. Maybe that makes sense, but I think as a whole, we might see a more even split of corn and bean acres than we're projecting right now. And to me, that makes these 25 corn look undervalued.
And Justin, any thoughts to add there?
Yeah, there's, we talk about this a lot every year. And, when you're in situations like this, when you talk about rented ground, especially in these high productivity areas, like we all know rents are really high and they've been really stubborn to come down. So, if you look at a factory or an industry like ethanol, they would typically produce as long as they're covering variable costs and there's a contribution to fixed. So in the short run, that one of the issues with that is, if people are going to pay, $400, $500, $600 an acre for rent, that's above what the fair price would be, right? So they're putting themselves into a loss by doing that, by renting that ground. Now in the short run, that's hard to fix, right? Because it's, kind of think of it as a fixed cost. Same with building a factory, and you're not going to shut that factory down as long as you're contributing to that fixed cost. So that's the hard part about saying, they're losing a bunch of money, so they're not going to plant. They're all going to plant is the problem. If this were to sustain for a while, there would have to be an adjustment in something, right? You're not going to keep paying, to rent ground that's going to lose you $200 to $300 an acre every year. So in the short run, it's probably going to be just a big drawdown in working capital if we don't have a flat price rally, in my opinion.
I would agree with that completely, especially in the high rent districts. But I do think there's evidence to say that really low prices lead to prevent plant being taken in fringe areas, though, too.
Yeah.
Right.
Yeah, and those are all things that have to happen probably with the current fundamentals. So unless something changes, all the things that we've talked about, right? Like maybe you don't have enough money for that third application, or you cut back on 10% of your costs some other way, which maybe not, the best thing to do agronomically, but it's kind of what you have to do. And the other, I got in this conversation with somebody yesterday as well. The other issue is just total dollars, which we talk about a lot here too, where you can see, switching, especially in some areas, to crops that just cost less money to plant. If you can get 20% more acres on the same dollar, because that's what your bank's willing to lend you or what you're willing to finance, that can make decisions that aren't 100% based on what's on paper. So I do think the combination of the two, I agree. I think that leans towards more beans naturally, unless we have a flat price rally. And we've seen that time and again. Low prices, you tend to get more beans. High prices, you get more corn, especially when the ratios get to an extreme. So,
Hey, Ben, any thoughts to add here this morning?
No, not on that same topic. I was just looking at December corn open interest, and in 5 weeks, they've cut it in half from roughly 750 down to 360. And we're on the clock here in the next 5 or 6 days before delivery becomes a possibility. So I think there's a lot of work to be done on the December contract over the next 5 or 6 years. How much comes off with options expiration will be telling. There'll be a big chunk there, but that's 5 weeks to get down to where we're at, and we have that much more to go. So I think it's worth keeping an eye on.
Yeah, I'll just add one more thing. As we're looking at those numbers, Dustin, I think if you look at all those, that's assuming kind of current prices. I think the biggest risk certainly is between now and when crop insurance is set in February, because there's, outside of hedging or doing something, there's nothing you can do to prevent that risk. So if, corn prices were to break 50 cents, beans were to break $1, let's say, all of a sudden those guaranteed revenues, everything that you can do has been diminished greatly. So certainly the biggest risk to the market for, growers as a whole is that, in my opinion, those new crop prices between now and when crop insurance is set. Just from the amount of guaranteed bush, the nice thing is that you have some of these bigger subsidies coming for ECO, but we don't have the price set yet. So, I think that's going to be a big factor on what those economics look like, the next 3 months.
Yeah, definitely. Dustin, anything to wrap up on this tide?
No. I think option expiration is definitely something to watch, like Ben mentioned. as of this morning, I think we're still way further into the ledger on the corn calls than the corn puts. So how does that wrap up over the next 2 days? Are those calls going to be taken into long futures? Are they going to be rolled out to March? What's the plan with that? Generally we think the long end of the option side is the position holder, and the short end has already been hedged off. That's not always the case, obviously, but I think currency moves, really wild, geopolitical headlines that continue to roll in. And so I would just say over the next couple of months, I think we've had a lot of fairly tame moves here for corn, especially. Just kind of keep in mind that might not be the case as we get into this new administration and start seeing some changes being made.
Yeah, it's interesting that they're looking at a Bitcoin crypto czar now, and Bitcoin's up 3,000 this morning, on the doorstep of 100,000, which is pretty interesting to see as well.
Certainly taking a big portion of available capital flowing into an asset, right?
Yeah.
You could almost say that has actually prevented some of the inflation we otherwise would have seen. A lot of money's been put into that.
Yeah, it's pretty incredible. Now, very good, Rylan. We're gonna have November feeders expire. Looks like at a record high. You got cattle on feed tomorrow at 2, and it was a nice pop in hogs yesterday, which was welcome to see.
Yeah, absolutely. I mean, cattle side of things still a little mixed. I think the market just wants to see what happens in cash this week. So far, we saw bids at 183.5 in the South and 187 in Texas, 187 offer in Texas. So, it almost looks like we could kind of see a steady trade, maybe even a little lower. I mean, the way that the beef is acting could be a possibility, but I think overall everybody wants to stay optimistic just between now and DS1, just especially considering the discount on the board relative to like last week's cash and some of the asking prices that we've seen so far. So I think there's just a lot in focus, and we'll see if there's going to be any surprise on the report. We're expecting some pretty big placement and big marketing numbers, so I think like that's going to be kind of the focus after the report here, especially on the placement side, just because it feels like this time of year can always be pretty volatile overall. But we're expecting those big increases from a percentage level on there. So we'll be watching for that. But yeah, I mean, overall, like we've been seeing open interest kind of climb here on these rallies. And at this point, the managed money is carrying just a massively long position in the meats, in the hogs, in the cattle, in the feeder cattle. So I mean, like, I think that just overall, maybe it's because of lower interest rates, maybe because of what's going to, potential tariffs on Mexico. There's a lot of reasons to be optimistic right now. It just feels like the trade's pretty crowded right now. We've seen open interest just absolutely explode. So I think this is a big risk. If there's anything to really tip the scales at all, it's good just to be prepared just in case we see some kind of big washout. I mean, it seems like there's obviously a reason for it. Maybe in a lower interest rate environment that's going to help support the prices over the X amount of months. But overall, it just kind of feels like that's where the trade is. That's how everybody's leaning, and everybody's pretty optimistic right now. So it just, like I said, these big headline trades, as Dustin kind of referenced, could have some pretty big impact. So it just feels like everybody maybe having a little bit of extra coverage ain't a bad idea.
Sure. And you've seen some, again, some out forward LRPs that are starting to open up that, potentially could look pretty inviting at these levels.
Absolutely. I mean, like the LRP situation, I mean, like obviously insurance, as we know, not a great trade, but like in this kind of high priced, historically high environment, as you just say, feeders went off at the highest November's about to go off at the highest it's ever gone off. So, I mean, like, looking out forward, we see some premiums start to develop. It's a really good idea just to start getting some quotes, seeing what's out there, seeing what you can do versus the board. It just makes a lot of sense right now.
Sure. It gives you a lot of flexibility too, right? I mean, there's
absolutely
things you can do.
It's just price coverage.
Right. No, very good. Again, that cattle on feed, as Rylan mentioned, that'll be out tomorrow, 2:00 Central. So he'll have a write-up in his evening commentaries, and I'm sure we'll talk about it Monday in the War Room. Tomorrow is Friday. We'll have Fun Fact Friday. Brian will bring something special for us like he always does. Appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like or subscribe. It'll keep you up to speed on everything AgYield. And again, we certainly appreciate everybody that tunes in and supports the show. I will get a quick rundown here of the markets as we just opened. December corn down a half at 429 3/4. January soybeans are down 2 at 988 1/2. And December Chicago wheat's up 4 1/4 at 556 3/4. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments there this morning, guys. It was a good show. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.